Our knowledge series on corporate tax in UAE. In this video you will learn about the qualifying groups. This video covers the following important matters: qualifying group relief, transfer of asset and liabilities within qualifying group, conditions to meet the requirements of qualifying group. Introduction. In the previous video, we have discussed the transfer of tax losses from one company to another in certain conditions. Where a qualifying group exists, it is also possible to transfer assets and liabilities on a nil gain or nil loss basis between members of a qualifying group as per Article 26 Clause 1 of the Corporate Tax Law. Similar to transferring tax losses, companies meeting the conditions do not have to make application to claim above stated relief for the transfer of assets and liabilities. Qualifying conditions. Under Article 26 Clause 2 of the Corporate Tax Law, a qualifying group between taxable persons is formed when all of the following conditions are met. The taxable persons are juridical persons and must be resident persons or, if a non-resident person, have a permanent establishment in the UAE. Either taxable person must have a direct or indirect ownership interest of at least 75% in the other taxable person, or a third person must have a direct or indirect ownership interest of at least 75% in each of the taxable persons. Juridical persons cannot be included in a qualifying group if they are either exempt from corporate tax or qualifying free zone persons. The financial year of the taxable persons must end on the same date. The taxable persons must use the same accounting standards. Using the same accounting period and the same accounting standards ensures that any relief surrendered by one company to another is matched appropriately and in the relevant tax period. It also reduces the likelihood of figures being manipulated leading to any abuse of the relief. The relationship between members of the qualifying group may be direct or indirect, that is, this may be a direct relationship between a company and its immediate subsidiary, or an indirect or effective holding in a sub-subsidiary. Ownership interests. Under the Article 2 Clause 1 of Ministerial Decision No. 132 of 2023 on transfers within a qualifying group, following are the permitted types of ownership interests: ordinary shares, preference shares, redeemable shares, membership and partner interests. Other types of securities, capital contributions and rights that entitle the owner to receive profits and liquidation proceeds. Article 2 Clause 2 of Ministerial Decision No. 132 of 2023 mentions, to qualify as an ownership interest, it must be treated as an equity interest by the holder of the interest in accordance with the accounting standards it uses to prepare its accounts. Article 2 Clause 4 of Ministerial Decision No. 132 of 2023 states, an Islamic financial instrument, or a combination of arrangements that form part of the same Islamic financial instrument, is treated as an ownership interest where it is classified as equity interest under the accounting standards applied by the taxable person. Exchange of assets and liabilities. According to Article 4, Clause 1, of Ministerial Decision No. 132 of 2023, where an asset or liability is exchanged for another asset or liability instead of for cash, the transfer shall be treated as two separate transfers for the purposes of applying the nil gain, nil loss rule as per Article 26 of the Corporate Tax Law. Administration. Under the Article 3 Clause 1 and Article 6 of Ministerial Decision No. 132 of 2023, where all the conditions are met, the companies automatically qualify and transfer of the asset file an election to the FTA for the relief to apply, in the form and manner prescribed by the FTA. Record of the transfer must be made in writing and held by both the transferor and transferee. As per Article 3 Clause 2 of Ministerial Decision No. 132 of 2023, the election must be made at the same time when the tax return is filed for the tax period in which the transfer took place. According to Article 3 Clause 3 of Ministerial Decision No. 132 of 2023, an election is irrevocable and will affect the taxable income of the tax period for which the election is made and all subsequent tax periods, unless the FTA determines otherwise in response to an application made by the taxable person. As per Article 3 Clause 4 of Ministerial Decision No. 132 of 2023, once an election is made, it will then apply to all transfers of capital assets and liabilities which are between members of the qualifying group. Illustration: qualifying conditions. FLLC owns direct shareholdings in the following companies: 95% of KLLC, 80% of ELLC, and 70% of NLLC. Based on ownership, FLLC and KLLC will be eligible to form a tax group if they choose to apply to do so, and if they choose not to form a tax group, FLLC, KLLC, and ELLC will automatically qualify to be treated as members of the same qualifying group. Relief for gains. Under Article 26 Clause 3 of the Corporate Tax Law, where an asset or liability is transferred between qualifying companies, it is treated as being transferred at net book value at the time of transfer, and value of the consideration is deemed to equal the net book value of the transferred asset or liability, that is, any actual consideration is ignored. Subsequent transfer rules. Under Article 26 Clause 4 of the Corporate Tax Law, where an asset or liability has been transferred between members of a qualifying group and within 2 years of the transfer, transferor or transferee ceases to be members of the same qualifying group. Asset or liability is subsequently transferred outside of the qualifying group, then the nil gain or nil loss provision will cease to apply, which may result in a clawback charge to corporate tax. These conditions are meant to prevent situations where an asset or liability is transferred to a member of the qualifying group, followed by that member exiting the qualifying group, resulting in any gain on the asset or liability transferred not being taxed, when corporate tax would have been due if the asset or liability had been sold directly to a party that is not a member of the qualifying group. According to Article 26 Clause 5 of the Corporate Tax Law and Article 5 of Ministerial Decision No. 132 of 2023, if the 2-year condition is not met, the transfer of the assets or liabilities is treated as having taken place at market value at the date on which the first transfer took place. This means that the gain or loss on disposal is recalculated using market value as the deemed proceeds, rather than net book value at the time of the transfer. This gain or loss on disposal will need to be taxed, or allowed, for the transferor in the tax period in which the condition ceases to be met. As per Article 5 Clause 2 of Ministerial Decision No. 132 of 2023, if the transferor has ceased to be a taxable person, the gain or loss that would have accrued to the transferor in the tax period in which the 2-year condition is not met, will instead be attributed to the transferee. Article 5 Clause 4 of Ministerial Decision No. 132 of 2023 mentions, where the 2-year condition is not met because a part of an asset or liability is transferred outside of the qualifying group, then the clawback charge is based on the proportion of the asset or liability that has left the group. Under Article 5 Clause 5 of Ministerial Decision No. 132 of 2023, where the 2-year condition is not met, transferee must make any necessary adjustments to its taxable income during the relevant tax period to reverse any depreciation, amortization, or other change in the value of an asset or liability that has been previously adjusted by the transferee for this transfer, subject to Ministerial Decision No. 134 of 2023 on the general rules for determining taxable income, and relevant provisions of the Ministerial Decision No. 134 of 2023 no longer apply for the current and future tax periods in relation to this transfer. Illustration: subsequent transfer rules. FLLC owns a direct shareholding of 85% in KLLC. Both companies meet the conditions to be eligible for qualifying group relief. On January 1, 2024, FLLC transfers the building to KLLC. At the time of the transfer, the building had a net book value of AED 5 million and a market value of AED 25 million. KLLC paid FLLC cash of AED 15 million for the building. Building will be treated as transferring for consideration equal to the net book value of AED 5 million. The actual cash consideration paid is ignored. There is neither a gain nor a loss on the transfer on January 1, 2024. KLLC is treated as acquiring the asset for the same cost as FLLC. In January 2025, FLLC sells all its shares in KLLC. This means that within 2 years of the transfer, the transferee ceases to qualify for relief. The original transfer on January 1, 2024 therefore needs to be recalculated using the market value at the time of the transfer as the deemed proceeds. This means that FLLC will be treated as realizing a gain of AED 20 million on which corporate tax is now due. KLLC will now be treated as having a base cost of AED 25 million. FLLC will need to include a gain of AED 20 million in its taxable income for the year ended December 31, 2025. This ends our video session. Subscribe to our channel and click on notification icon to stay tuned to the series of valuable material that will cover all aspects of the UAE corporate tax. Our partner is available for free consultation who is holder of FTA approved UAE corporate tax qualification. His contact details are provided here. Visit finexcel.ae. Navigate to our clients and testimonials webpage to see more clients' review on our services and our major clientele. Contact us for more detail. FinExcel. We create value that matters.